Yo, what is up? Today we're going to talk about how to trade gaps successfully. And although I have many videos on gaps already, what I'd like to do in this video is just go through the basics for anyone new to trading gaps. Because I find that when I make a video on a specific aspect of gap trading, I get too in-depth, and a lot of new gap traders lose the main idea of how gaps are traded and what you need to look for. So let's start with the first thing, which is either you already have a gap you see in a stock that you're holding or looking to trade, or you want to trade gaps but you don't know where to find them. So the first step there, if you don't know where to find gaps, is simply Google bar chart, which is what I use to find gaps. It gives you the daily gaps, bar chart, and then you can type up gaps or down gaps. Down gaps. Either of those works. Of course, we're going to have to learn the difference between up gaps and down gaps, but you're going to learn that very quickly. As you'll see, it's a very easy concept. So we're going to type in bar chart, up gap, and that'll give us the page we want to go to. And in there, if you want to check the down gaps, all you have to do is in the URL, change the word up to down, and that'll give you all the down gaps. So we'll do that right now. And you'll see what's listed are all the gaps from the current day or the most recent trading day. Now, what gaps do you trade from this list? Here we've only got a small list. Up gaps were probably more the other day because the market was generally bullish. Now, there's two ways I like to arrange this. If I am trading for a very short period of time, if I'm looking to do a swing trade or a day trade, I will arrange it by the price. Gaps on stocks with larger prices are easier to make profits on because a small movement can mean a lot of profit. But if you're holding for a longer time, or if you just want to make sure that you're not losing money due to the spread, which is essentially the difference between the bid and the ask for a certain stock, you're going to want to arrange by volume. And that'll give you the most popular stocks, which are the easiest to trade gaps on, but don't necessarily bring you in a lot of profit. I also have a rule in either case. So let's say I'm trading by the price. I'm not going to play a gap with only this type of volume. It's too low. I want a volume of at least 500,000. If I really like the price or if I really like the gap, I'll go a bit lower. But you're generally going to want to look for at least 500,000, if not 1 million in volume. Now, if you're arranging by volume, it's the same issue. Look at the price. I generally don't trade anything below, I would say, $25 or so. That $20 to $30 range is a lot harder to make a profit on. Anything above 30 is pretty good. Anything below 20 is going to be a lot harder to make a profit on. And in these penny stock regions, unless you're dealing with a large amount of money, it's going to be hard to get those little incremental gaps. And I'm going to show you what I mean there. So what's the difference between a gap up and a gap down? It's pretty simple. Here we're looking at Moo. This is a gap up. And then we're going to look at most biggest volume here, which is GameStop. So we're going to look at these two. GameStop, you switch it to about 30 days. Drag these down so we're just looking at the candlestick chart. Now, when you're looking at gaps, you want to use the candlestick chart. Is not being a very effective way to drag it down, huh? You don't want to use the candlestick charts because that's what shows you the gap. If you're not looking at the candlestick charts, if you look at the lines, you're not going to see that gap. So a lot of traders who are looking at this type of movement for a stock don't even know what gaps are. They don't see the gaps on the chart. When you switch to the candlesticks, however, you see there's a big space between the candlesticks for each day. There you got a gap down, and here you got a gap up. It should be quite apparent what the difference is. One is the most recent candlestick is much higher than the trading region of the previous day's candlesticks, and the other one is the opposite. The gap down brings a candlestick way below the trading region. Now the question, after you find that gap, so you found the gap, find the gap. Now you got to ask yourself, and by the way, in this find the gap area, we're asking if it's tradable or not. That's what we did with the volume and the price. Next, we're going to want to ask ourselves, is this an area gap or a breakaway gap? Now, if you've taken my course on gap trading, you know the difference quite clearly between the area gap and the breakaway gap. But if you're new to gap trading, you might not know the difference. And the difference tells you how to trade the gap. If it's an area gap, what it means is that the gap is going to fill. In other words, the stock is going to move up in this case, and eventually there's going to be a candlestick that gets us back to this level. And if it's a breakaway gap, we just keep going further, and that gap almost never fills, or it doesn't fill within the trading period that we're looking at. So we need to ask that question, and we need to answer that question. And I answer it with two different methods. And if you've taken my courses, one is the gap game plan method, and I have a new course exclusive only to my Vario University students, which is the Gap Game Plan 2 method, which is a lot faster and requires a lot less analysis and is more profitable, but it also requires you to take on a bit more risk. So the main difference between these two strategies is in the Gap Game Plan 2.0, we open the trade right after the gap. So we either open it at the end of this day or the next trading day, and we play the gap that way. For the Gap Game Plan, we played a lot more safer, and what we do is essentially watch the chart for a couple more days until we get the trading signal, which is based on a few things, but most notably it's based on the candlesticks. And once we get that trading signal, we know whether it's going to be an area gap or a breakaway gap with a pretty high probability. The Gap Game Plan 2.0 is a lot more simple. We generally just look at the candlestick patterns. Here we see we use a pre-gap candlestick and a post-gap candlestick to get a pretty good estimate as to whether that gap is going to fill or not fill. And what I'm looking at here in GameStop, I'm thinking the gap's going to fill, which means we are going to want to take a long position and wait for the stock to hit 24, and we take that $4 profit on a $20 invest. And for Micron, this one looks like it's going to fill as well. So we recently, in my Copy My Trades program, which you could just find on my website, demonvario.com, we opened a position on what I was looking at before, Nike. So on the day of this gap, it looked like it was going to fill, and it's getting there. It's almost filled. So you can see the profitability here, because basically we have only we've got a $4 space to fill between these two candlesticks, and it doesn't seem like a lot, but we use options and we get what seems to be leverage. It's not really leverage, but we're getting a lot more profit on every dollar movement, and we're doing that via options, which gives us essentially $100 for $1 movement. So your next question is, are you going to play it with options and get that leverage and some basic risk protection, or are you going to do it with stock, which is, I guess, safer in the long run because there's no expiration date. You can wait forever for that gap to fill. You can also get dividends if it's a dividend payer, but you're not going to get that type of leverage. So in this situation in Nike, if you're just going to buy it outright, you're only going to get about $2 profit for every $100 invest. But if we play this with options, depending on the option you buy, you could double the amount of money you put in. So I generally recommend options, especially when we're playing area gaps, because area gaps, we know exactly what our price target is going to be. So there you go. Find the gap, determine whether it's area or breakaway gap. I have two methods for doing this, and then determine what your trading vehicle for that gap play is going to be. And, well, the exit strategy for area gaps is pretty simple. You have a price target. When the stock hits that price target, you get out. For breakaway gaps, it's a lot harder, and I have a pretty detailed method of exiting a breakaway gap plan in the Gap Game Plan. You could check that out. But in general, what you're going to want to look for is how long does a breakaway gap tend to go before it levels off. And this is where it's important to be able to analyze an individual stock instead of just general trends. So while I, in the Gap Game Plan 2.0, give you some strategies on generally what you should do in each situation, when I do my own trading, I run algorithms on individual stocks so that I know if this stock differs from the general. Now, let's see if we can't find a breakaway gap. Let me think if we had one recently. There might be one in one of those big tech stocks. Um, let's see here. Netflix, maybe. Not loading. Facebook, maybe. No, so I'm not seeing anything, but imagine, okay, here we go. This looks like a breakaway gap right here. So I'm going to go back 90 days. Maybe went back a little too far. Ah, here it is. So you see this gap? It looks like a small gap between these two green candlesticks. Now, this is actually an area gap. I know because it filled, but I would also have guessed it's an area gap because green generally doesn't lead to a rally after an uptrend like this, and also we don't see a high amount of volume on that day of the gap. So I would have guessed this is an area gap, but let's, for just an example, imagine it's not. Let's say this turned into a breakaway gap and we got this really long momentum on Facebook. How will you know how to exit that trade? Well, one of the methods I give to Gap Game Plan students is measure the last, or if you can, last few post breakaway gap trends like this, like these rallies. How long do they go? What percentage did it move upward? And set your price target there. Another way to do it is to set a time. So if you saw before that most rallies will last for a week or 2 weeks, then you'll set your exit point at 2 weeks after the gap. If you want to do it by time, if you want to look at seasonality, you can go back and you can check generally what seasons or what months of the year that stock does well in and when it's likely to pull back. And if you can do that, you can get a pretty good general trend for that stock and know that maybe even though the gap recently occurred and you want to ride the breakaway rally, maybe it's close to October and we see that 60% of Octobers in Facebook show a pullback, and it's generally just not a safe time to hold at that time. You might set your exit at the end of September, which is 100% positive anyway, so it's a good time to hold for the long term. In any case, once you have your exit strategy and your entry point, which you need on the Gap Game Plan, but you don't need on the Gap Game Plan 2.0 because the entry point is simply the next day. Once you have those two things, open the trade with whatever you've chosen, options or stock, and that's pretty much it. If you're playing specifically area gaps only, that can be a pretty conservative way to make consistent profits. The play I just showed you, the Nike play that we're running in my newsletter on my website, this one that's closing, my algorithm showed that if we played this consistently, we would make 15% per year, which is pretty much double what you expect to get from just a normal index fund. And you're not going to be exposed all year round. You're only going to be opening a trade and keeping it open when there's a gap on Nike in this case. So you would have, well, I wouldn't, I'd have to do analysis on this gap to know whether I would have determined this would be a breakaway or area or whatever, because this type of candlestick right here is typically pretty hard to deal with. This is called a doji star. You see where the body is almost nothing. It just looks like a cross. Those are a lot more difficult to analyze and predict. But I mean, every time you see a gap in Nike, that would be your signal to trade. And if you just did that and didn't trade anything else, based on my back test, it shows that you would make 15% per year. And that's pretty conservative. And once you add options into the mix, you can set your risk level at a very clear point. And I'm going to be putting out an options course in the near future. So if you're interested in learning how to manage risk with options and how to leverage your money with options, please do stay tuned. So yeah, I didn't get too much into the most important part, where 90% of gap trading is, which is determining whether the gap is an area gap or a breakaway gap. But I do have other videos for free on this YouTube channel that explain those. And then I have these two courses, the Gap Game Plan, which is for more conservative traders, and Gap Game Plan 2.0, which is for more tolerant of risk traders, that go really in depth in understanding how to determine which one's an area gap and which one's a breakaway gap. So that's it. I hope this has answered questions of people who said, "Hey, I saw your video on gap trading, but you didn't really explain the general how-to of it." So that was the point of this video. If you liked this video, please let me know in the comment section below and leave a request for whatever else you'd like to see from this YouTube channel. I am happy putting out free information for those who appreciate it and especially for those who actually use it. Thanks, guys. Stay tuned.